Welcome back to the Pro Ticker Podcast, your Monday morning edition, covering major financial magazine headlines, everyone. We've really got quite a stack of material this week. We've pulled reporting from, the big names, CNBC, Reuters, Bloomberg, Yahoo Finance. And our mission today, really, is to try and analyze this, startling convergence we're seeing. You've got this revolutionary AI investment driving the market highs, but it's clashing head-on with these historic valuation alarms and, immediate political turmoil right around the corner.
Yeah.
We're looking for those insights that explain sort of why all this excitement and this, existential risk seem to be peaking at the very same time.
It's like you're flooring it in a supercar, right? But every single warning light on the dashboard is flashing red.
Exactly.
The market's running hot on this incredible tech excitement, but underneath there's this deep structural fragility and maybe more importantly, immediate instability risks coming out of D.C. Just days away now. This is really a stability check for the whole global system, I think.
Okay, let's start with that fuel then. The source of the excitement. The AI economy, and specifically OpenAI.
Yeah.
I mean, the sheer scale of capital needed here is driving headlines.
Yeah.
Even as this private startup, valued at, $500 billion now?
$500 billion, that's the number.
Is reportedly still burning through, as they put it, mounds of cash.
And that cash burn, it's not just, keeping the lights on. It's the cost of building the actual infrastructure.
Yeah.
We're seeing deals that just rewrite the playbook for pre-IPO capital commitment.
You certainly are. I mean, looking at the reporting, you have to focus on these colossal deals for their $500 billion Stargate infrastructure program. There's a $300 billion purchase commitment from Oracle.
Huge.
Then the $22.4 billion infrastructure commitment from CoreWeave. And they had to ramp that up from about $12 billion earlier this year.
Yeah,
right?
that's right. Yeah, doubled it almost.
And then, of course, the big one. NVIDIA investing up to $100 billion in OpenAI, which gets NVIDIA equity and future revenue back.
What stands out to me isn't just the size, even though, like you said, OpenAI's CFO, Sarah Fryer, is only projecting maybe $13 billion in revenue for 2025 against all that spending.
Right.
What's really maybe troubling is the interconnectivity. Analysts at Bespoke Investment Group called it a self-referential ecosystem.
That's the .com parallel people are drawing, isn't it?
Exactly.
Where your supplier, NVIDIA, invests $100 billion into its customer, OpenAI.
Yeah.
Who then uses that money to buy NVIDIA chips to build the data centers, funded by the investment. It feels circular.
Precisely. Bespoke argues it looks a lot like vendor financing. You remember that pattern that flared up just before the dot-com bubble burst back in the early 2000s?
I do.
They explicitly said, and I'm quoting here loosely, if NVIDIA has to provide the capital that becomes its own revenues down the line, well, the whole growth model might just be unsustainable. You have to ask, are these companies creating real value, or is it just a highly leveraged closed loop?
That's a serious point. But I guess I have to push back a little. Sam Altman, OpenAI CEO, he defends the spending. He calls this a once-in-a-century opportunity.
Right.
His argument is this isn't just hype. It's what's necessary to build the foundation for the next century of computing.
Right.
A bold bet, like the early internet pioneers who also faced, skepticism about spending so much.
Sure.
So how do we tell the difference? Necessary build-out versus, pure financial froth.
Well, one way is to step back from the individual companies and look at the market's overall temperature. And that brings us, of course, to the famous Buffett indicator.
Okay, here's where it gets really interesting for me. So this indicator measures the total value of U.S. stocks, the Wilshire 5000, against the country's gross national product, GNP. And Warren Buffett himself, he famously warned back in the early 2000s, if that ratio gets near 200%, you are, and this is his quote, playing with fire.
And according to recent CNBC reporting, where are we now?
Wow.
A whopping 217%.
Wow, 217%.
Yeah. It's not just high, it's an all-time record. Higher than the dot-com peak, higher than any other historical point. It suggests equity values are just expanding way faster than the underlying U.S. economy.
Wait, are we really that far into the red zone? I also saw the S&P 500's price-to-sales ratio hit 3.33. Another record, right? Way above the 2.27 peak in 2000.
We are, by that traditional yardstick, yes. But we have to address the counterpoint you raised earlier.
Okay.
There's a significant argument that maybe the Buffett indicator is, outdated. It was designed for a 20th century economy, right? Manufacturing hard assets.
Right.
Today's economy is built on tech, IP, software, data networks, intangible assets. Maybe market cap should be higher relative to GDP or GNT now.
So, okay, a credible argument that the market's high for a reason, the economy's different. But then what do we make of what the Oracle of Omaha himself is doing?
His actions, that's maybe the ultimate practical guide, isn't it?
Seems like it.
He's currently sitting on, what is it, $344.1 billion in cash at Berkshire Hathaway.
It's staggering.
It's a cash pile the size of a medium country's GDP. And he's been a net seller of stocks for 11 straight quarters.
11 quarters.
So when the guy who basically invented the alarm bell is hoarding cash and selling stocks while the bell is screaming 217%, well, that tells you pretty clearly he thinks risk outweighs reward right now.
And that links perfectly to our next bit. If the most trusted voice in finance sees this uncertainty, imagine what the Fed is facing with political instability looming. Let's pivot from valuation risk to the immediate, very tangible risk. The October 1st government shutdown, it seems. Well, all but certain now, doesn't it? Disputes over budgets, healthcare subsidies expiring.
And the stakes feel higher this time around. It's not just the usual furloughs. The administration is threatening actual mass firings in certain programs. That adds a whole new layer of risk for the U.S. labor market itself.
But the critical market risk, the one Nomura analysts flagged, is this potential data desert. If the Bureau of Labor Statistics shuts down data releases, we lose visibility. Crucial reports like the September jobs report due this Friday. Gone.
Right.
Economists were looking for maybe, 43,000 new non-farm payrolls? Modest growth. If you lose that, the Fed's in real trouble.
Flying blind is the perfect phrase for it. Losing sight of key indicators means the Fed goes into its next meeting making policy based on old news, essentially.
Yeah.
Cleveland Fed President Beth Hammack actually said publicly, this is a challenging time for monetary policy, especially because inflation is still sticky. She pointed out core PCE hit 2.9% annually in August.
So way off target.
Yeah, the Fed's missed its 2% target for over 4.5 years now.
So normally, strong data, like we've seen 3.8% Q2 GDP, low jobless claims that would make the Fed hesitate on cutting rates aggressively.
Right. Keeps the bulls in check.
But if there's no fresh data because of a shutdown, ironically, it might make them just stick rigidly to their existing plan. What, 2 more cuts signaled for 2025? Simply because they have no new reason to change course.
Exactly. It could actually increase policy risk. Lack of information usually breeds caution, or maybe sticking to the last known plan.
Right.
And meanwhile, that same administration is throwing massive trade friction into the global system.
Which takes us to Trump's latest tariffs. This expansion of protectionism. New duties on heavy trucks, furniture, but the really aggressive one seems to be the 100% duty on patented pharmaceuticals.
With some exceptions if you invest heavily in the U.S.
Right. Build plants here.
And the global pushback is immediate and intense. South Korea just balked at the required investment, $350 billion they were asked for. They basically said it's objectively and realistically not a level we are able to handle.
Can't blame them. Could trigger financial crisis, they said.
Yeah, and it makes Japan's similar $550 billion pledge look even more, well, remarkable. The details there are still pretty murky.
And we're already seeing companies react. AstraZeneca, the pharma giant, planning a dual listing in New York, pledging $50 billion for U.S. manufacturing by 2030, clearly trying to get ahead of those tariffs.
Absolutely. And this corporate maneuvering, it highlights a really deep strategic shift in U.S. policy, doesn't it, toward securing critical supply chains, moving away from pure free market thinking.
How so?
Well, the blueprint seems to be the Pentagon's direct equity stake in the rare earth minor MP materials.
That was a fascinating move, the U.S. military getting directly into commodity markets.
It really is. The deal guarantees a price floor $110 per kilogram for NdPr oxide, a key rare earth element. And what happened? The NdPr price jumped 40% almost immediately after.
Wow.
So now they're looking at using this model for other critical minerals where China dominates lithium, cobalt, graphite. We're seeing proposals for similar equity stakes, like potentially in Lithium Americas for their Thacker Pass mine. The goal seems to be securing supply almost regardless of short-term market prices. Strategic capitalism, really.
Okay, let's shift focus briefly. Over to the Asia-Pacific region. Markets there started the week mostly higher, despite all this global uncertainty. South Korea's Kospi up 1.33%. Hang Seng jumped 1.89%. Japan's Nikkei 225 dipped a bit, though, down 0.69%.
Yeah, the interesting corporate story there was Sony out of Japan. Sony Group spun off Sony Financial Group successfully. The spin-off shares closed up 15% on their Tokyo debut.
Good start.
It signals a very clear strategic choice by the parent company, right? spin off the financial arm to focus investment capital intensely on their core growth areas, entertainment and semiconductors. Makes sense.
Okay, now let's try and tackle the China paradox, because we've got really conflicting signals here.
We do.
On one hand, China's industrial profits apparently rebounded sharply in August. Soared 20.4%, the biggest jump since November 2023. That sounds like a strong recovery.
It sounds great, yeah. But analysts are waving caution flags saying this rally seems kind of disconnected with the economic fundamentals.
Why is that?
Well, look at the other data points. Industrial output growth actually slowed to 5.2%. Domestic demand looks weak. Retail sales growth slowed for the third month in a row.
So, if the consumer isn't driving profits, where did that big jump come from?
It seems almost entirely policy-driven. The rally is largely down to Beijing's recent anti-involution push.
Anti-involution.
Yeah, basically a campaign to stop destructive price wars and cut back excess supply in various industries. It helped upstream sectors like raw materials, non-ferrous metals.
Okay.
But the recovery was also really uneven. State-owned enterprises saw profits jump 50% versus only 13.2% for private firms.
Ah, so SOEs benefited most.
Exactly. And the big vulnerability here is the market structure itself. Retail investors dominate China's onshore markets like 90% of trading. So that optimism gets priced in really fast, making the market quite vulnerable if that profit surge doesn't actually filter down the supply chain.
Got it. Okay, finally, let's look at energy. Another disconnect here seems like between global supply fears and regional pricing. Globally, oil prices dropped. Brent fell below $70 a barrel. Fears of a supply glut.
And the supply fears are pretty justified. OPEC Plus is talking about another small output hike, maybe 137,000 barrels a day for November.
Right.
Plus, you've got an Iraqi pipeline restarting, adding more barrels. That pushes futures down.
But then, in fascinating contrast, Saudi Arabia is apparently planning to increase its November crude prices for its Asian buyers
Right.
by 20 to 60 cents a barrel.
Right. That move really highlights their specific regional strategy. They see the global supply risks, sure, but they're also looking at stronger Middle East benchmarks and using this pricing power to get maximum value from that lucrative Asian market while still trying to regain market share. It shows the oil market is being fought regionally now, not just on global averages.
So wrapping this all up,
Yeah.
what does this mean for you, the listener, heading into the week? We're seeing this huge flow of capital into truly revolutionary tech like AI, driving these historic valuation metrics. That 217% Buffett indicator number is just, wow.
Yeah.
But at the exact same time, you've got immediate political uncertainty, the shutdown, the trade war stuff, threatening the very data we need to even assess the risk properly.
We have a market built on, let's face it, a lot of optimism, leverage, and this deep interconnection, especially in AI. And it's suddenly facing a potential severe self-inflicted data blackout. So the final thought maybe to ponder is this. If the Federal Reserve genuinely loses its visibility on inflation, on jobs, right when that Buffett indicator is at 217%, and the market structure is so intensely self-referential, how could policy mistakes ripple through?
Yeah, what happens then?
The impact of a data desert at these historic highs, it really goes beyond just economics. It becomes a question of market governance, maybe even political failure. Lots to watch.
We'll see you all tomorrow morning with new headlines from major financial magazines.